Hey, what's up guys? Welcome back to IronHawk Research. We are a group of people who are very passionate and dedicated about spreading financial literacy to help people to build better financial futures. So today we are going to talk about a very useful and powerful concept in finance. It's called the CAPM, the Capital Asset Pricing Model. The name might be scary, but it's actually very simple. So today we're going to briefly walk you through the definition of this model and then demonstrate an example using Excel. Without further ado, let's get right into it. So the capital asset pricing model describes the relationship between systematic risk and expected return of an asset. The CAPM involved to measure this systematic risk. It is widely used throughout finance for pricing risky assets and generating expected returns for this asset. Now let's take a look at the formula. So this is the formula for CAPM, and you can see on the left hand side we have the expected return for this asset, and this expected return is equal to risk-free return plus beta times the market risk premium. And the market risk premium is equal to the expected return of this market minus the risk-free rate. We have talked about beta in the previous video. Beta just means the systematic risk of this asset, or it measures how volatile this asset compared to its benchmark or to the market. And return of the market is the return of the benchmark that you chose to compare with this asset. In most cases, if you're calculating the beta for a stock, you would choose an index like the S&P 500 or other indices to represent the stock market. So the CAPM model can be used to calculate first the expected return of this asset if you know the risk-free rate, and then you know the beta of this asset, and you know the return of this market. Or you can calculate the beta of this asset if you know the returns of this asset, the risk-free rate, and the return of this market. So today we're going to demonstrate an example of how to use CAPM model to calculate beta of a stock by using Excel. So in this Excel sheet, we have the daily price data for SPY and Apple stock. SPY is an ETF that represents the S&P 500. We're going to use this as our market or as our benchmark. So first of all, what we need to do is to calculate daily return based on these daily price data. How are we going to do that? So first of all, we need to calculate return from these price data. So to calculate return, we simply take today's return divided by yesterday's return and minus 1, which is in this case is B3 divided by B2 minus 1. And we copy this formula over and then drag this formula down. Now we have the daily return for SPY and for Apple. Next, we need to figure out the risk-free rate. So in our case, we're going to assume the risk-free rate is 3% constant. But remember, we have daily data here, so we need to divide the 3% by 252 to get daily returns. Remember, there are only 252 trading days in a year. So 3% divided by 252. Drag this thing down. Now let's take a look at this formula. We have risk-free rate here, and then we have risk-free rate here, right? So in order to calculate beta, we need to move this risk-free rate here to the left-hand side. And then you will have the expected return of this asset minus the risk-free rate is equal to beta times the market risk premium. So in our case, we need to subtract the risk-free rate from the returns of SPY and the Apple stock. this is the SPY subtract the risk-free rate, and we copy it over, and this is Apple subtracting the risk-free rate, and then we drag this down. With these two columns, now we can go ahead and perform a regression analysis to get beta for the Apple stock. So in order to perform a regression analysis in Excel, you need to, first of all, go to the Data tab, and then click on Analysis Tools, check Analysis Toolpack, and click OK. And then you'll see this pop up, the Data Analysis tab. Okay, so click that, and then you'll see regression. Click OK. So it'll ask you to input X and Y range. So what does that mean? So Y range is our dependent variable, which is the left-hand side of our formula, and X range means the independent variable, which is the right-hand side of our formula. So on the left-hand side of our formula, we have the return of this asset. So in our case, it's the return for Apple stock. And on the right-hand side of our formula is the market return, so which is the return of the SPY. So let's go ahead and input those values. On the left-hand side, we have Apple. And on the right-hand side, we have S&PY. And click Label, and click OK. Let me make this larger. So after you click OK, Excel will spit out the results in the new sheet. So this is the result. So where's beta? Beta is the coefficient of SPY. So in this case, it's actually 1.24668. This value is very close to the value that we calculated in the previous video about beta, because we're using the same data set. Because Apple has a beta of 1.25 roughly, it means that Apple is more volatile than the S&P 500 index. And remember, we only used 1 year of data to calculate this, so this number means that for the past year, Apple has been more volatile than the S&P 500 index. So this is how you use the CAPM model to calculate beta for a stock. If you like our video, please give us a thumbs up, and if you want to learn anything, please leave a comment down below. Thank you very much for watching, and I'll see you next time.